When trillions of dollars depend on trust, even questions can shake markets. This is the story of an unprecedented investigation, the independence of central banking, and why what happens next could reshape global finance. Before we begin, a critical note: this video covers an active investigation. No charges have been filed, no one has been convicted of any crime. What you're about to hear involves allegations, scrutiny, and unanswered questions. We're examining why this matters, not rendering judgment. If you want clear, factual breakdowns of the biggest financial stories without hype or bias, subscribe now. We cover the stories that move markets and shape economies. Let's begin. The Federal Reserve is arguably the most powerful financial institution on earth. It controls interest rates that affect everything from your mortgage to global currency values. It manages trillions in assets. It can create money with the stroke of a keyboard. And it operates with something that's supposed to be sacred in central banking: independence from political pressure. At the center of this institution sits one man, Jerome Powell, the chair of the Federal Reserve, appointed by the president but designed to operate free from political interference. His decisions move markets. His words are parsed by traders worldwide. His credibility is the foundation of confidence in the American financial system. In January 2026, something unprecedented happened. And what makes this particularly significant is not just what occurred, but what it reveals about the delicate balance between oversight and independence in modern finance. According to multiple news reports, including CBS News, Reuters, and ABC News, the Department of Justice served the Federal Reserve with grand jury subpoenas. These weren't routine requests for information. According to Powell's own public statement on January 11, 2026, these subpoenas threatened a potential criminal indictment. The subject? Congressional testimony Powell gave in June 2025 about a renovation project at Federal Reserve headquarters. Now, you might be thinking a building renovation sounds mundane, but here's why this situation has financial markets, legal experts, and former central bankers deeply concerned. To understand the implications, we need to examine exactly what's being investigated and why it matters far beyond a construction project. The Federal Reserve headquarters in Washington sits on Constitution Avenue. The building complex required renovation and expansion. This wasn't cosmetic work. This was a multi-year project involving security upgrades, technology infrastructure, and modernization of facilities that house one of the world's most important financial institutions. Projects like this are expensive. They involve significant resources. And because the Federal Reserve operates within the government framework, even though it's designed to be independent, Congress has oversight responsibilities. Lawmakers ask questions about costs, timelines, and justifications. This is normal. This is appropriate. This is how democratic oversight works. Powell appeared before Congress and answered questions about this renovation. He provided testimony about the scope, the necessity, and the cost of the project. According to published reports, federal prosecutors are now examining whether that testimony was accurate and complete. But here's where this gets more complex than a simple factual dispute about construction costs. The investigation reportedly focuses on whether Powell or the Federal Reserve misrepresented information about the renovation scale or expense. And the tool being used is a criminal investigation with grand jury subpoenas threatening potential indictment. Powell has publicly confirmed that subpoenas were issued. In his statement, he characterized the investigation as unprecedented in the history of the Federal Reserve. He has denied any wrongdoing. The Federal Reserve has stated it provided accurate information to Congress. Federal Reserve officials have maintained that all testimony was truthful and complete, but the investigation continues, and what makes this situation particularly fraught is the context in which it's happening. Because this isn't occurring in a vacuum, this is happening during a period of documented tension between political leadership and the Federal Reserve over monetary policy. To understand why this tension matters, we need to understand what the Federal Reserve actually does and why its independence is considered essential to economic stability. The Federal Reserve sets interest rates. When you hear about rate hikes or rate cuts, that's the Fed. These decisions affect borrowing costs for everyone, from individuals with credit cards to corporations financing expansion to governments funding deficits. The Fed also controls the money supply. During crises like the pandemic, the Fed can create money to support the economy. During inflationary periods, the Fed can tighten money supply to cool things down. These are enormously powerful tools, and they're supposed to be wielded based on economic analysis, not political preference. Here's why that independence matters. Politicians generally want low interest rates. Low rates make borrowing cheap. They stimulate economic growth. They make voters happy because mortgages are affordable and stock markets tend to rise. Politicians facing elections have strong incentives to pressure central banks to keep rates low. But sometimes economic conditions require raising rates. When inflation is running hot, keeping rates too low makes inflation worse. It can create asset bubbles, it can destabilize the economy. The Federal Reserve is supposed to make these difficult decisions based on economic data, even when those decisions are politically unpopular. This independence is why the Federal Reserve Chair doesn't report to the president daily. It's why the Fed chair has a fixed term that doesn't align with presidential terms. It's why there are institutional protections designed to insulate monetary policy from political pressure. These protections exist because history has shown what happens when central banks become political tools. Now let's return to our investigation. In January 2026, Powell confirmed that the Department of Justice served the Federal Reserve with grand jury subpoenas. According to CBS News, these subpoenas threatened a criminal indictment connected to Powell's June 2025 testimony about the headquarters renovation. Reuters reported that the federal investigation drew condemnation from former Federal Reserve chairs. ABC News confirmed the Department of Justice launched a criminal investigation. These aren't rumors, these aren't speculation, these are confirmed facts reported by multiple credible news organizations. What exactly is being investigated? According to published reports, prosecutors are examining whether Powell's testimony to Congress about the renovation project was accurate. The focus appears to be on statements about costs and scope. Did the Federal Reserve fully disclose all aspects of the renovation? Were estimates provided to Congress accurate? Were there misrepresentations either intentional or unintentional? Now here's what makes this investigation so controversial, and this is crucial to understanding why financial markets and institutions are watching carefully. Multiple former Federal Reserve chairs have publicly condemned this investigation. These are people who served in the same role Powell now holds, people who understand the pressures and responsibilities of the position, people from different political backgrounds who rarely agree on much. Their concern isn't about protecting Powell personally. Their concern is about the precedent being set. If a Federal Reserve chair can be criminally investigated over testimony about a building renovation, what message does that send? Does it mean any testimony that politicians dislike could trigger criminal investigation? Does it create a chilling effect where Fed officials become afraid to testify candidly? According to analysis from Harvard Kennedy School, the investigation represents a tension between legitimate oversight and potential political interference in monetary policy. The question isn't whether Congress should have oversight. The question is whether criminal investigation is an appropriate tool for that oversight, especially during a period of documented policy disagreements. Oregon Public Broadcasting reported on the subpoenas in the context of what they described as a broader pressure campaign on the Federal Reserve. This framing is important because it situates the investigation within a larger pattern of tension between the administration and the Fed. Reports from NASDAQ and financial news services have discussed how the subpoenas may impact confidence in Federal Reserve independence. This gets to the heart of why this matters beyond the specific facts of a renovation project. Market confidence in the Fed depends on believing the Fed operates independently based on economic analysis rather than political pressure. Let's talk about what that pressure has looked like. This isn't speculation, this is documented public record. There have been public statements criticizing Federal Reserve policy. There have been calls for the Fed to change course on interest rates. There have been suggestions that the Fed chair should be more responsive to political leadership. None of this is necessarily inappropriate. Political leaders have the right to express views on economic policy. They have the right to disagree with Federal Reserve decisions. What concerns observers is whether criticism crosses from legitimate disagreement into improper pressure designed to influence monetary policy. The investigation into Powell's testimony about a renovation project is happening against this backdrop, and that context shapes how the investigation is perceived. Is this a genuine inquiry into potential false statements, or is this a tool to pressure the Fed chair during a period of policy disagreement? The answer to that question matters enormously. Now let's examine what happens when trust in a central bank is questioned, because even if no charges are ever filed, even if the investigation concludes with no wrongdoing found, the mere existence of the investigation has effects. Markets operate on confidence. Institutions operate on credibility. When those are questioned, there are consequences. Bond markets are particularly sensitive to Federal Reserve credibility. Treasury bonds are considered the safest investment in the world. That safety is based partly on the belief that the Federal Reserve will maintain stable monetary policy free from political manipulation. If that belief is shaken, bond yields can become more volatile. Investors might demand higher returns to compensate for perceived risk. Currency markets also react to central bank independence concerns. The dollar's status as the global reserve currency is supported by confidence in American institutions, including the Federal Reserve. If markets begin to question whether the Fed can operate independently, the dollar could weaken. This would have cascading effects on global trade and finance. Gold prices often rise when trust in central banks declines. Investors view gold as a hedge against institutional instability. During periods when Federal Reserve independence is questioned, gold has historically attracted increased interest. This isn't just theoretical. This is observable market behavior based on decades of data. Investor confidence more broadly can be affected. Businesses make investment decisions based partly on expectations about future interest rates and monetary policy. If they believe monetary policy might become subject to political pressure, rather than economic analysis, investment decisions become harder, uncertainty increases, capital becomes more cautious. These market effects can occur even without any proven wrongdoing. The investigation itself, the questions it raises, the uncertainty it creates, these factors alone can move markets. This is why the situation is being watched so closely by financial institutions worldwide. But there's an even deeper question here about institutional trust and the rule of law. The Federal Reserve is an institution. It exists beyond any individual. Its credibility is built over decades through consistent, independent policy making. That credibility is an asset more valuable than any physical infrastructure. When an institution like the Federal Reserve is subjected to what former chairs have called unprecedented criminal investigation over testimony about a renovation project, it raises questions. Are all institutions equally subject to this level of scrutiny, or are some institutions being targeted because of policy disagreements? These questions don't have easy answers, but they need to be asked. The Department of Justice has the authority and responsibility to investigate potential crimes. If there's evidence that someone lied to Congress, that's serious. Lying to Congress is a federal crime. It undermines the oversight process. It damages public trust. Prosecutors have a duty to pursue credible evidence of such lies, but that authority must be exercised carefully, especially when investigating officials at independent agencies. The question isn't whether the Department of Justice can investigate. The question is whether this investigation is based on credible evidence of wrongdoing or whether it represents improper pressure. We don't know the answer to that question. The investigation is ongoing. The evidence hasn't been made public. We don't know what prosecutors have found or what they're examining. We're operating with limited information. And that's by design. Grand jury investigations are confidential. We only know what has been publicly confirmed. What we do know is that Powell has denied wrongdoing. The Federal Reserve has stated its testimony was accurate. Former Federal Reserve chairs have condemned the investigation as unprecedented, and financial markets are watching nervously as this plays out. Let's examine the historical context, because this situation doesn't exist in isolation. Central bank independence is a relatively modern concept. For most of history, money and monetary policy were directly controlled by governments. Kings debased currency to fund wars. Governments printed money to cover deficits. The results were often catastrophic inflation and economic instability. The modern central bank model emerged from recognition that monetary policy needed to be insulated from short-term political pressures. The Federal Reserve was created in 1913 with a structure designed to balance accountability with a structure designed to independence. It reports to Congress, but it operates with protections against political interference. This balance has been tested many times. Presidents have publicly criticized Federal Reserve chairs. There have been efforts to influence monetary policy through various means. Sometimes these tensions are public, sometimes they're behind the scenes, but certain lines have traditionally not been crossed. One of those lines involves using criminal investigation as a tool to pressure the Fed chair. This is what makes the current situation unprecedented, according to former chairs. Not that there's oversight, not that there are disagreements, but that a criminal investigation has been launched in connection with testimony about a building renovation during a period of documented policy tensions. We need to be clear about what's being alleged and what's not. The investigation reportedly focuses on Powell's congressional testimony about the renovation project. The question is whether that testimony was accurate and complete. There are no allegations of personal corruption. There are no claims that Powell personally benefited financially. The focus is narrow. Was his testimony truthful? This narrow focus is part of what makes the investigation controversial. If prosecutors believe Powell lied to Congress about the renovation, that's a serious charge that warrants investigation. But if the investigation is being used as leverage over policy disagreements, that's a dangerous precedent. We don't know which it is. The investigation continues. Meanwhile, the Federal Reserve has to continue operating. Interest rates still need to be set. Monetary policy still needs to be managed, the economy still needs stewarding, and all of this happens while the institution's leader is under criminal investigation. This creates extraordinary pressure. Think about the position Powell is in. He has to make decisions about interest rates that affect millions of people. He has to testify before Congress on economic policy. He has to manage an institution with thousands of employees. And he has to do all of this while facing potential criminal indictment over testimony about a building renovation. Does this affect his decision making? Does it make him more cautious? Does it influence how aggressively he pursues policies that might be politically unpopular? We can't know for certain, but the mere possibility that it might have such effects is concerning to those who care about central bank independence. The investigation also affects how other Federal Reserve officials operate. If the chair can be criminally investigated over testimony, what about other Fed officials? Does this create an environment where officials become afraid to testify candidly? Does it encourage carefully parsed statements designed to avoid any possible misinterpretation? These chilling effects can damage the oversight process itself. Congressional oversight works best when officials testify honestly and completely. If officials become afraid that any statement could later be scrutinized as part of a criminal investigation, they may become less forthcoming. This makes oversight harder, not easier. Now let's examine what experts and observers are saying about this situation. According to Harvard Kennedy School analysis, the investigation highlights tension between oversight and interference. This is a crucial distinction. Oversight is necessary and appropriate. Interference undermines institutional independence. The question is where the line falls. Is a criminal investigation into testimony about a renovation project legitimate oversight, or does it cross into interference when it occurs during documented policy disagreements? Different observers reach different conclusions based on their perspectives and available information. Some argue that no official should be above scrutiny. If there are questions about whether testimony was accurate, those questions deserve answers. The Department of Justice has tools to pursue those answers, including subpoenas and grand jury investigations. Using those tools isn't automatically improper just because the subject holds an important position. Others argue that the choice to pursue criminal investigation rather than other forms of oversight is significant. Congress has its own investigative powers. It can hold hearings, it can demand documents, it can issue subpoenas through congressional committees. Deploying criminal investigation tools suggests a different level of seriousness. What's particularly notable is the response from former Federal Reserve chairs. These are people who have held the position Powell now holds. They understand the pressures, they've faced congressional testimony, they've navigated policy disagreements with administrations, and they're speaking out against this investigation. According to Reuters, former chairs have condemned the investigation. This condemnation is unusual. Former chairs typically avoid commenting on their successors or current Fed matters. Their silence is part of maintaining institutional credibility. When they break that silence to condemn an investigation, it signals something significant. Their concern appears to be less about the specific facts of the renovation testimony and more about the precedent being set. If a Fed chair can be criminally investigated over building project testimony during policy disagreements, what protection does independence really provide? This is the question driving their public statements. Financial markets are processing all of this in real time. Every news report about the investigation is analyzed. Every statement from Powell or the Fed is parsed. Every development is assessed for what it means for monetary policy credibility and institutional independence. So far, markets have remained relatively stable. There hasn't been a crisis of confidence, but there's increased uncertainty, and uncertainty itself has costs. It makes planning harder, it makes investment decisions more difficult, it creates volatility. Bond traders are watching whether the investigation affects Federal Reserve decision-making. If the Fed seems to be adjusting policy in response to political pressure rather than economic data, that would be a significant concern. So far, Fed decisions appear to be following economic logic, but the scrutiny is intense. Currency markets are monitoring whether the investigation affects global confidence in the dollar and American institutions. The dollar's reserve currency status depends partly on belief in institutional stability and independence. Any erosion of that belief could have profound effects. International observers are also watching closely. Central banks around the world look to the Federal Reserve as a model for independence and credible monetary policy. If the American model appears to be compromised by political interference, it affects global perceptions of how central banks should operate. Some countries with less established central bank independence may see this as validation of their more politically controlled monetary policies. Others with strong independence traditions may view it as a cautionary tale about the constant pressure central banks face. The investigation also raises questions about accountability and transparency. The Federal Reserve is a powerful institution. It should be accountable to the public through their elected representatives. Congressional oversight serves an important function in ensuring that accountability, but there's a difference between accountability through oversight and accountability through criminal investigation. The former involves questions, hearings, and public scrutiny. The latter involves subpoenas, grand juries, and potential prosecution. The tools are different, the implications are different. Defenders of aggressive oversight argue that important officials sometimes need to face serious consequences for false statements. If Powell's testimony about the renovation was inaccurate, that matters. Congress relies on accurate information to perform its oversight function. False testimony undermines that function and warrants serious response. Critics of the investigation argue that the choice to pursue criminal inquiry into testimony about a building renovation during documented policy tensions appears designed to pressure rather than genuinely investigate. They point to the unprecedented nature of criminally investigating a Fed chair over such testimony. We're left with a situation where reasonable people disagree about what's happening and why. Some see legitimate investigation into potential false statements. Others see improper pressure on an independent institution. The truth may lie somewhere between these perspectives, or it may clearly support one side once all facts are known. What we can say with certainty is that the investigation is unprecedented. Multiple credible sources confirm this. Of former Federal Reserve chairs who have collective centuries of experience with the institution describe it as without precedent. That doesn't automatically make it wrong, but it makes it significant. We can also say with certainty that the investigation is happening during a period of documented tension over monetary policy. This is observable fact. There have been public disagreements about Federal Reserve decisions. There have been calls for policy changes. This context shapes how the investigation is perceived, and we can say with certainty that Powell has denied wrongdoing and the Federal Reserve has maintained its testimony was accurate. These denials are on the record. They may be true, they may be incomplete, but they represent the Fed's stated position. Now let's think about what happens next and why it matters. Several scenarios are possible. The investigation could conclude with no charges filed. This would suggest prosecutors found no evidence of criminal wrongdoing. It would presumably vindicate Powell and the Fed, but it wouldn't erase the fact that the investigation happened and the questions it raised. Alternatively, charges could be filed. This would be extraordinary. A sitting Federal Reserve chair facing criminal indictment would be unprecedented. It would create immediate questions about whether Powell could continue in his role. It would likely trigger a crisis of confidence in the institution. Markets would react sharply. A third possibility is that the investigation continues indefinitely without resolution. Grand jury investigations can take months or years. The uncertainty could persist, creating ongoing doubt and pressure. This might be the worst outcome for institutional credibility, as questions linger without answers. Each of these scenarios has different implications for Federal Reserve independence, market confidence, and institutional credibility. The outcome matters not just for Powell personally, but for the precedent it sets and the message it sends about how independent agencies operate. There's also the question of what this means for future Federal Reserve chairs. If this investigation becomes a template for pressuring the Fed during policy disagreements, future chairs will face similar threats. This could affect who's willing to take the job. It could affect how they approach controversial decisions. The best candidates for Federal Reserve Chair are typically people with strong credentials, clear judgment, and willingness to make unpopular decisions based on economic analysis. If the position becomes one where you face criminal investigation when your policies displease political leaders, the pool of qualified candidates might shrink. This gets to a fundamental question about governance in a democracy. How do we balance accountability with independence? Elected leaders should have oversight over government functions, but some functions like monetary policy and judicial decisions are designed to be insulated from political pressure. Finding the right balance is an ongoing challenge. The Federal Reserve structure attempts to strike that balance. It's accountable to Congress through reporting requirements and testimony, but it's independent in its day-to-day operations and policy decisions. This structure has worked more or less for over a century, but it requires restraint on all sides. Political leaders must exercise restraint in how they pressure the Fed. They can disagree, they can express views, but they shouldn't use improper tools to force policy changes. The Fed must exercise restraint in maintaining its independence while remaining accountable. It should be transparent, honest in its testimony, and responsive to legitimate oversight while protecting its policy-making authority. When either side fails to exercise appropriate restraint, the balance breaks down. If the Fed becomes unaccountable, that's a problem. If the Fed becomes subject to political control, that's also a problem. The current situation tests whether that balance can hold. For ordinary people who don't follow financial markets or monetary policy closely, you might wonder why this matters. Here's why it matters. The Federal Reserve's decisions affect the economy you live in. Interest rates affect your mortgage, your car loan, your credit card. They affect whether businesses invest and hire. They affect inflation and purchasing power. If the Federal Reserve makes decisions based on sound economic analysis, those decisions may not always be popular, but they'll generally serve long-term economic stability. If the Federal Reserve makes decisions based on political pressure, those decisions will serve short-term political interests at the expense of long-term stability. History shows what happens when central banks lose independence. You get cycles of boom and bust driven by political calendars rather than economic fundamentals. You get inflation when governments pressure central banks to print money. You get instability that hurts ordinary people through job losses and eroded savings. This is why central bank independence isn't just an abstract institutional concern. It's about whether your economy is managed for long-term stability or short-term political gain. It's about whether the money you save retains its value. It's about whether you can plan for the future with some confidence about economic conditions. The investigation into Jerome Powell's testimony about a renovation project might seem removed from these big questions, but it's connected. If investigations can be used to pressure Fed chairs during policy disagreements, that affects how future chairs make decisions, and those decisions affect your economic reality. So where does this leave us? We have a confirmed investigation. We have denied wrongdoing. We have condemnation from former chairs. We have documented policy tensions. We have market uncertainty. And we have fundamental questions about institutional independence. We don't have charges. We don't have a trial. We don't have a verdict. We have an ongoing investigation and unanswered questions. This is the nature of the situation. It's ambiguous. It's unresolved. It's creating uncertainty. The responsible approach is to watch carefully, demand transparency where appropriate, and avoid prejudging the outcome. If the investigation finds evidence of wrongdoing, that should be taken seriously. If it finds nothing, that should be acknowledged. And if it appears to be a tool for improper pressure, that should be condemned. What's clear is that this situation matters far beyond the specific facts of a renovation project. It matters for precedent. It matters for independence. It matters for confidence in institutions. It matters for how markets function. and it matters for the global financial system that depends on credible, independent central banking. The investigation continues, the questions remain, and the implications extend far beyond Washington, touching every corner of the global economy, because when trillions depend on trust, even questions can shake markets. And right now there are many questions and few answers. The Federal Reserve was created to provide stability, to make difficult decisions based on analysis rather than politics, to serve as an anchor in turbulent economic seas. Its independence isn't about protecting the institution from accountability, it's about protecting the economy from short-term political manipulation. Whether that independence survives this moment remains to be seen. The investigation will conclude eventually, charges will be filed or they won't, but the precedent being set, the questions being raised, the uncertainty being created, these effects will last regardless of the investigation's outcome. This is the challenge facing not just Jerome Powell and the Federal Reserve, but anyone who cares about institutional independence, economic stability, and the balance between accountability and autonomy. The answers matter, the process matters, and the precedent matters. So we watch, we wait, we analyze, and we ask the questions that need asking, even when the answers are unclear, because in a system built on trust, questions matter almost as much as answers. And right now, the questions are piling up faster than the answers. Thanks for watching this edition of the Allegation Files. These are complex situations with real implications for markets, institutions, and society. We'll continue following this story as it develops, always with careful attention to facts, context, and what it means for the systems we all depend on. Subscribe for more investigative financial coverage. And remember, in finance, as in justice, the process matters as much as the outcome.